Do not pay off your mortgage before you retire until you watch this video, because writing that final check to the bank could be the single biggest financial trap of your entire life. It sounds like the absolute ultimate American dream. You spent 30 or 40 years grinding out a career, making monthly payments, and looking forward to the day you can finally rip up that mortgage paperwork, throw a housewarming party, and enter your golden retirement years completely debt-free. The psychological relief of knowing that no lending institution can ever evict you from your own property is an incredibly powerful emotional force. It is an image that has been systematically drilled into our heads by traditional finance gurus as the absolute pinnacle of financial security. But behind that beautiful emotional dream lies a massive, high-stakes financial minefield. Making this move without understanding the underlying math can permanently lock up your liquid cash, trigger an aggressive tax penalty from the Internal Revenue Service, ruin your healthcare subsidies, and quietly cost you upwards of $100,000 in lost generational wealth. Most people make this life-altering choice based purely on a gut feeling or outdated advice from their parents' generation, leading them to make catastrophic adjustments to their investment portfolios right at the finish line of their careers. Today, we are stripping away the emotion, looking at the cold, hard numbers, exposing the modern retirement tax traps, and giving you a comprehensive, professional decision matrix to know precisely whether you should kill your mortgage early or keep it running. To understand why this choice is so dangerous, we have to look at the foundational clash between two distinct financial concepts: liquid net worth and home equity. When you take a massive lump sum of cash out of your retirement accounts to pay off a mortgage, you need to understand that you are not actually changing your net worth by a single penny on paper. You are simply shifting money from the left side of the ledger to the right side. You are taking money out of a highly liquid, accessible asset class, like stocks, bonds, or cash, and trapping it inside a completely illiquid asset, which is the physical bricks, mortar, and dirt of your home. Here is the problem. The grocery store will not let you buy food with your home equity. The gas station will not accept a piece of your drywall. And your local utility company will not accept a portion of your roof as a payment for your monthly electricity bill. If a major medical emergency arises, or the global stock market takes a sudden violent dive right as you enter retirement, having a fully paid off home means absolutely nothing if your bank accounts are completely dry. You become what wealth managers call house poor, sitting on a massive pile of real estate wealth, but completely starving for monthly cash flow. In a crisis, trying to get that money back out of your house through a home equity line of credit or a reverse mortgage when you no longer have an active recurring job income is incredibly difficult, highly expensive, and sometimes completely impossible because banks are hesitant to lend money to retirees without a traditional paycheck. Furthermore, we must address the absolute modern illusion of the mortgage interest tax deduction. For decades, the standard, generic financial advice told workers to never pay off their mortgage early because the interest was fully tax deductible, acting as a great shield against the IRS. But the structural architecture of the tax code has completely flipped. With the federal standard deduction sitting at historic, unindexed highs, exactly $32,200 for married couples filing jointly, the vast majority of retirees no longer itemize their deductions. If you are taking the standard deduction like over 90% of Americans, your mortgage interest is giving you absolutely zero federal tax benefit. You are paying full interest to the bank completely out of pocket, with no relief from the government whatsoever. But here is where the real professional math kicks in, and it centers completely around the exact interest rate on your specific loan. If you are smart or lucky enough to lock in a fixed mortgage rate during the historic macro lows of a few years ago, sitting on a rate of 2 or 3%, paying off that loan early is mathematically buoyant, irrational, and actively destructive to your wealth. If you have a 3% mortgage, but you can securely park your cash in a low-risk, high-yield savings account, a certificate of deposit, or a government treasury bond yielding 4 or 5%, you are making a guaranteed spread on your money. By leaving your cash in the bank rather than giving it to the mortgage company, you are generating more passive income than the interest you are paying to the lender. In this specific scenario, keeping the mortgage is a highly profitable, risk-free arbitrage play that builds your net worth every single month you stay alive. Conversely, if you bought your home or refinanced during a high interest rate cycle, where your mortgage sits at 6, 7, or 8%, paying it off early is the exact equivalent of achieving a completely guaranteed, risk-free, tax-free 7 or 8% return on your money. There is nowhere else in the modern financial markets where you can secure a risk-free return that high, making an early payoff a brilliant, dominant tactical move that immediately optimizes your balance sheet. But the absolute most dangerous trap of paying off a house early isn't the lost investment return. It is the catastrophic self-inflicted tax bomb triggered by how you fund the payoff. Let's say you owe $150,000 on your remaining mortgage balance, and you decide to pull that exact amount out of your traditional 401k or traditional IRA to wipe the debt out in a single day. Because traditional retirement accounts are funded with pre-tax dollars, every single dollar you withdraw is treated as ordinary income in the eyes of the law. A $150,000 withdrawal added on top of your normal income will instantly launch you into the absolute highest marginal federal and state tax brackets. You aren't just paying off the bank, you are volunteering to write a massive check for tens of thousands of dollars in unnecessary tax penalties to the government. Even worse, that massive artificial spike in your adjusted gross income will instantly trigger the dreaded provisional income thresholds, suddenly causing up to 85% of your Social Security benefits to become fully taxable. It can also push you over the Medicare premium adjustment cliffs, causing your monthly healthcare costs to skyrocket by hundreds of percent for the next year. You are essentially burning a massive portion of your life savings out of pure impatience. To make an accurate professional assessment, we must also look closely at the concept of sequence of returns risk. When you retire, the order in which you experience investment returns matters immensely. If you deplete your liquid cash to pay off the house, and the stock market crashes during the first 3 years of your retirement, you will be forced to sell your remaining stocks at rock-bottom prices just to pay for basic living expenses like groceries and insurance. This permanently damages the compounding power of your portfolio, making it highly likely that you will run completely out of money in your 80s. However, if you keep your retirement accounts fully funded and maintain your liquidity, your portfolio has the structural strength to ride out a market downturn, allowing your investments to fully recover when the market swings back upward. Keeping a large pool of liquid investments gives you a defensive shield that a paid-off house simply cannot provide. Another critical factor to integrate into your strategy is your exact structural retirement timeline. If you plan to exit the workforce early, say at age 60 or 62, you face a dangerous coverage gap because you do not become eligible for Medicare until your 65th birthday. During these early retirement years, securing private health insurance through the government exchanges is incredibly expensive. The cost of your premiums is determined entirely by your reported taxable income. If you pull a massive lump sum out of a traditional retirement account to pay off your house early, that artificial income spike will completely destroy your eligibility for health insurance subsidies, forcing you to pay thousands of dollars extra out of pocket just to stay insured. By keeping your mortgage and keeping your taxable withdrawals smooth and controlled, you can keep your reported income low enough to qualify for maximized healthcare subsidies, saving your family a fortune during those vulnerable pre-Medicare years. If you absolutely hate the emotional weight of a mortgage and want that debt gone before you retire, you must execute the strategy with surgical precision to avoid these penalties. Instead of a reckless lump sum withdrawal, you must use a multi-year amortization strategy. You can systematically make extra principal payments over a 5 to 7 year window leading up to retirement, drawing down modest, controlled amounts from your accounts to stay strictly within your current low tax brackets. Alternatively, you can use a mixed strategy where you leave your low-interest mortgage fully intact, but you build a dedicated liquid cash buffer inside a high-yield savings account that is mathematically equal to the remaining balance of the loan. This gives you the ultimate double victory. You retain complete liquidity and control over your wealth in case of an emergency, while achieving the exact same psychological security, because you know you have the cash to wipe out the debt at any exact moment you choose. Ultimately, the decision to pay off your house before retirement is not a simple choice between debt and freedom. It is a highly sophisticated equation that must balance your liquid cash needs, your specific interest rate, your tax exposure, and your personal risk tolerance. The math does not care about your emotions or your neighbour's advice. The math only cares about capital efficiency and preserving your purchasing power over a 30-year retirement horizon. Stop looking at your mortgage as a personal failure and start analysing it as a structural piece of your total financial architecture. Run your own numbers, protect your liquidity, minimise your exposure to the IRS, and build a strategic plan that guarantees your long-term independence. Thank you so much for watching today's deep dive. If you got real value and tactical clarity out of this breakdown, please hit that like button, subscribe to the channel so you never miss a professional wealth building update, and drop a comment down below letting me know your exact strategy for managing your mortgage in retirement. Your support means the absolute world, and it helps us keep bringing you the honest truth about your money. Thanks again for watching. Keep your eyes on the math, and we will see you in the very next video.